Hi there everybody and welcome back to another stock analysis video. Today I would actually like to analyze the company Walt Disney. Now I know I said it in my Sony video that I actually wanted to see Nintendo. However, Disney just had earnings and well, it turns out that they actually missed on their earnings by around 12.2%. They were being estimated at $1.20 and they only got $1.08. So let's actually analyze this company. As you guys can see right here, it is down about 2.3%. So let's analyze this company based on their fundamentals and see what price we should be paying for them. With that said, let's get started with this analysis. We're going to jump right into this calculator, guys, because unfortunately Disney does not pay a dividend. Now they used to. They used to because I remember that I used to have Disney. In fact, I even remember that they paid it semi-annually as well. However, after COVID, they essentially just cut their dividend because, well, they lost a lot of revenue and net income because of that. And we're actually going to see that in the charts. But that's because of the fact that COVID occurred. But nonetheless, we got the ticker symbol for Disney of DIS. Market cap of $191.5 billion. PE, guys, of 62.44. So just based off of this PE, this is telling me that at the current share price of $105, right? $105. It might be a little bit expensive. However, we're going to see other metrics to see what we should be paying for this company. In regards to their dividend, since they don't have one anymore, their 5-year average free cash flow and just their cash flow in general is going into themselves to pay down debt, buy back shares, and reinvest in themselves and to grow the business. Now let's come over here and see their fundamentals, starting with a net income, guys, 5 years ago of 8.9 or essentially just $9 billion to 1 year ago of almost $2 billion. Guys, that is a decrease of 78%. Now, obviously, the big elephant in the room here is the fact that 2 years ago, they were in the negative by around $3 billion. However, if you take a look at when this 2 years ago happened, it was mainly because of the fact that COVID happened. They had to shut down all their parks. And you're probably wondering, sure, but what about this one? Why is this one still so low? Well, it's also due to the fact that as of 2021 is when actually the restrictions, at least in Florida, the restrictions started coming off. Now, there are still restrictions in California, but that's beside the point. The main aspect as to why this is this low is because they are actually gaining back their revenue through their parks, through Disney World. So this is essentially why, even though this is still pretty low, it is starting to inch back into the positive. Taking a look now at the free cash flow 5 years ago of $8.7 billion to 1 year ago of, again, $2 billion. Now, that is a decrease, guys, of 77% with a 5-year average free cash flow of only $5.2 billion. Now, something here to note is, again, they actually fell, right? When it came to their free cash flow 2 years ago, they fell to around, what, $3.6 billion, and then 1 year ago, they continued to fall to around $2 billion. However, something very, very concerning here is that 3 years ago, they actually fell all the way down to $1.7 billion from the 4-year ago mark of almost 10. So I don't necessarily know what caused this fall 3 years ago. However, as you guys can see right here, when COVID did happen, they actually did a little bit better when it came to the free cash flow, probably because they didn't have a lot of capital expenditures. And then 1 year ago, because they probably brought back their capital expenditures, then their free cash flow actually went down. Now looking at the revenue, we got 5 years ago of $55 billion to 1 year ago of $67 billion. Guys, that is an increase of 22.27%. And ironically enough, we didn't really see much of a dip when COVID happened. In fact, from 3 years ago, we went from what, $69.6 billion to when COVID hit of around $65.4 billion. Now the main thing as to why I think caused this decrease, of course, COVID, but the reason why I don't think it was much of a decrease is because I believe Disney Plus started to take off, right, as soon as COVID happened, and I think Disney even prioritized it. And well, Disney is a major corporation. They have a lot of brands, especially old-timey classics that people tend to like. So a lot of people just started to sign up for Disney Plus, seeing that they couldn't go out anymore, which probably explains as to why this number of 65 billion is actually not as bad as you look at it in comparison to the overall aspect of the situation that was occurring 2 years ago. Looking now at the total assets minus the total liabilities, guys, currently they're at $103 $0.6 billion in total assets minus the total liabilities. What this means is that if they were to liquidate all of their assets, they would still have left $103.6 billion after paying down their liabilities, which is really solid. And not only that, they have been positive within the past 5 years as well. Average total assets around $166 billion, average total liabilities around $81.7 billion, or at least $81.8 billion. Average assets minus the average liabilities, we get around $84.4 billion. Now let's look at the shares outstanding, and this was actually fairly surprising because I actually wasn't expecting Disney to be issuing shares. Now Disney is a major corporation, so you would at least expect them to be at least buying back shares. However, we don't see that in this situation. Guys, you want this number to be coming down because a shares outstanding tells you how much the company is diluting you. As you can see right here, 5 years ago of 1.5 billion shares to today of 1.8 billion shares. That is an increase on the 5-year of 18.79%, and from the previous to the current year, we are looking at what, 1 year ago to today, they actually brought it back at around 0.88%. However, this decrease is not enough to offset this 5-year number. So as it stands, they are issuing shares, and what's ironic too is that they started issuing shares not when COVID happened, right? It was a year before COVID happened, so that's actually fairly surprising. They're diluting you. This is a really bad metric. And lastly, we got the cash equivalents, and currently they have around $14.4 billion with an average cash around $10.3 billion. Now time to make some assumptions, low, medium, high. Taking a look at it with 3 different factors: revenue growth, predicted share buyback, and required rate of return. Guys, for the revenue growth, I like to use Seeking Alpha's growth tab, looking at the revenue growth year over year and the revenue growth forward, making an assumption between those 2 numbers. Try to be conservative. Disney's a major corporation. Predicted share buyback, I'm going to be using the shares outstanding graph that we just saw. And for the required rate of return, keep it flat, 10%, to match the S&P 500. You can alter this required rate of return if you so wish to do so. I personally like to keep it at around 10%. So for my lowest assumption, let's say a revenue growth of 15%, predicted share buyback of -5%, this comes out to be $25.38. For my median assumption, a revenue growth of 20%, predicted share buyback of -3%, this is $30.30. And lastly, for my highest assumption, a revenue growth of 25% and a predicted share buyback of -1%. This comes out to be around $36, essentially $35.99. Now, let's actually adjust for debt. The way we do this is we take the cash and equivalents, which is why I like to look at it, and then we take a look at the net debt. We add those 2 together, and then we add that to the market cap that the discounted free cash flow calculator comes up with. And in doing so, we get a target share price of, for the low assumption, $12.05, for the median assumption, $16.70, and for my high assumption, $22.12. Now let's add a margin of safety on top of that, just because you don't want to overpay for something. Every investment, guys, is the present value of all future cash flow. You do not want to overpay for something. All of these numbers that we have seen are based off of these revenue growths and predicted share buyback, and of course required rate of return. So if we add a margin of safety of 5, 10, and 15%, this will actually save us just in case things were to really hit the fan, right? In doing so, for the lowest assumption, I would personally like to buy between $10.24 to $11.44. For my median assumption, $14.20 to $15.87. And lastly, for my highest assumption, between $18.80 to around $21. Now, the current share price is 105. So as you see, this is pretty much just telling me that this is very overpriced. And I'm 100% certain that I'm going to get comments in regards to the, how can you get 25? That is insane. There's no way that this thing could fall that much. Well, let me just show all of you guys something that you're probably not seeing right away. And that is the fact that, guys, Disney, after it rallied after the whole COVID thing happened, Disney went all the way up to $202, as you can see right here, $202. And currently they are at what? $105. So as you can see, they have fallen around $100 or so. In fact, given the exact number to that, this is currently down 44.62% from the peak of that $202. So the fact that I'm getting these kinds of numbers this low, and guys, again, that the fact that the PE is 62, yeah, it's pretty much just telling me that this company is overpriced at the moment. Now, whether you agree with these numbers or not, that's not the point. The point is that it is overvalued and that you want it to come down a significant amount as well. So That's why I'm essentially getting $35 from a highest, or $36 from a highest, and the low of $25 for a target share price, not adjusting for debt. Now, as I always say in every single video, these numbers are based off of my assumptions. If you do not agree with them, by all means, don't agree with them, that's fine. Understand though that my assumptions are based on the fact that this company is not worth $105 per share, right? It's not worth of a market cap of almost $200 billion, right? It should be worth a lot less. I'm not saying Disney's a bad brand, I'm not saying that at all, but remember that when you buy a share of a company, you are buying a piece of that company, and what you buy from that company is essentially their cash flow, their net income, and their debts as well. All of their good stuff as well as their bad stuff. So that is why I like to make conservative projections into the future to come up with these target share prices. If you do not agree with them, fine, that's perfectly fine. I have this calculator available for free in my calculators playlist. I also have the book value one as well, and a dividend tracking sheet. If you do not agree with my assumptions, please have this calculator, make a copy of it, and you make your own assumptions, right? Because at the end of the day, this is not financial advice, and every investment is the present value of all future cash flow, as I said. For example, let's say that you think that Disney will continue to increase their revenue at like 50%, and you think that they're actually going to start buying back shares at 5%, right? Keeping the same required rate of return, this is actually now $76 stock, right? For the target share price, not adjusting for debt. Do I personally believe that this is going to happen? No, because they have no track record within the past 5 years of actually buying back shares. I mean, they did, but recently they have issuing shares within the past 5 years, right? So that's essentially why I'm putting it like this. But again, you guys can have the calculator available for free. Make your own assumptions. That's not financial advice. Make your own assumptions, and you come up with a target share price that you believe best suits this company based on their future cash flow. All in all, guys, when it comes to Disney, I used to own this company. I got rid of them when they cut their dividend, because I'm like, well, you know, they're only paid semi-annually, and the fact that they cut it, I'm not, you know, it's like, I understand why they cut it, but I'm not, they just completely went off from my strategy, so I don't really see the point in holding them anymore. If they were to issue this dividend again, I will come back and actually reassess this, assuming that they actually reach my target share prices. But as it stands right now, Disney, I personally am waiting for it to buy this company if I so wish to do so. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. As I said, you guys can follow me on my new tech sites of BitChute, Odyssey, and Rumble. Also have a Let's Play channel, link in the description below. So if you want to see that, you can follow me there as well. With that said, peace out, and be on the lookout for the next stock analysis video.